this is just I'm going to go through this quickly. Canada's in much better shape. Typically, we have a higher unemployment rate because we have a higher frictional unemployment rate. Just because we have a greater geographic area to deal with, people don't move as quickly to different jobs. That's the frictional part of the unemployment. But today, we look pretty good. And this just shows the blue line after the recession shows what's happened to unemployment in the US. The red line shows what's happened in Canada. Our economy is looking pretty good, but we will be tied to the US economic growth. Now, the third factor, the US banking system, is exemplified here. This is the S&L crisis in the US. This line shows the number of US financial institutions that failed in a year. So this is a lot of small institutions. Assets, which are the bars, not so much. This is our little financial crisis we just had. Assets up in the multiple billions, trillions. We're seeing over time, this is just a shorter time horizon we're looking at, the number of failing institutions is still rising in the US. And it's mostly the regional banks. This is a pair of indexes we follow, the KBW bank indexes. This is large banks in the US. They're doing not too badly right now. These are regional banks, improving, but still failing at too high a rate to be promoting a recovery. Banks need to lend money into a recovery or it doesn't happen. Regional banks are a primary motivator, a primary feeder of smaller companies in the US, and those banks are failing at a much higher rate. The fourth factor I wanted to point out was global credit markets, and I'll go a little bit deeper into this because sovereign debt plays a big part in this. This is our crisis here. And what we're showing is, and this is terminology, so I'll apologize in advance, but it's the LIBOR OIS spread. In words, London Interbank Offered Rate versus an overnight index swap rate. So a lot of jargon, but what it's really saying is that LIBOR is the rate at which banks decide to lend money to each other. 16 banks, internationally, this is a global rate, decide to lend each other money. It determines the interest rate benchmarks on $360 trillion of financial products in the world. That's why when you read about LIBOR in the papers, it's important. Because it's determinant of what's going on with financial products, including loans, mortgages, those kinds of things across the world. OIS is really, that swap rate is what is a proxy for risk-free rate. So what we're taking is what banks are willing to lend to each other at and what's risk-free, which is usually basically based on the federal funds rate in the US. So what's critical about it, and what happened here was banks wouldn't lend to each other. Even the big banks were saying, we don't trust each other to lend money to each other overnight. So the key here is this is what froze the financial system, a lack of liquidity. We weren't moving money into the marketplace the way it needed to. Now, recently, again, 4 weeks ago, this was a pretty good story. But what's happened in the last little while, this is just taking, if you recast the chart, this goes back, this is the peak in October of 2008, and it goes down. It looks like we've got a little blip here. Well, this is what's happened in the last month. And this is attributable to what happened starting off with Greece. So what you're seeing is this level going from just under 9 basis points, or 0.09 of a percentage point, up to almost 20. This isn't dangerous. Remember, this is extremely bad news. What we've got now is, let's be careful about what's going on. That's why you saw $1 trillion going in to help out Greece. And others, by the way, and I'll show you a slide on that. It's this trend that we follow to say, what's liquidity like in the market? Without liquidity, we don't get a recovery, a sustainable recovery. How does this affect capital markets? I'll put these slides up to show you. The green line at the top is Canada. The next line down is the EFI index, so Europe, Australia, Far East, Australasia, Far East. And the bottom line is the S&P 500, all in Canadian dollars. All I've done here is show you, you can see on your slide, the moving averages. And that's a way to say one measure of whether the value is appropriate in the marketplace. So when you hear in the papers about valuation, what does that mean? Well, one measure is to say, take the 200-day moving average, and are you above it or below it? If you're above it, the technical jargon is you're overvalued. Because on an average, you have a higher value than what the 200-day average is. So what we tend to try and follow is, where are we with the capital markets? It looks here like the US is slightly overvalued, end of April. EFI's fairly valued based on 200-day moving average, and Canada's slightly overvalued. But a more important indicator for me is what's going on in the US. And this is, again, a valuation measure, is to take Professor Schiller, who's a Yale professor, and take another measure that he uses, which is going back to 1900 and smoothing out price-earnings ratios. So if you think about how we decide what to pay for a stock, one way is to look at what's the company producing in earnings, and how much am I willing to pay for those earnings. That's a pretty simple relationship. It becomes more complex, obviously, with other factors compared, but that's what a price-earnings ratio is. How much is an investor willing to pay for a unit of earnings? So if you say that's a way of valuing, that's a way of looking at what's the value. So over a period of time, going back to the 1900s, what I like about what Schiller's done here is he smoothed it over 10 years. So earnings averaged over 10 years. So it's not just a very discrete period of time. It takes something that's a little more meaningful because it's averaged out. Since 1900, the median real price-earnings multiple was just around 15 times. So if you're looking at that, that's how much you'd be willing to pay for a unit of earnings. What we're seeing right now, and this is April 15th, so just over a month ago, in the US, S&P 500, 22 times. So again, capital markets right now would look, and this is going back, but they're still roughly in that area right now, to be, by some measures, overvalued. In that sense, it's not pointing towards a sustainable recovery. And my final economics geek slide is the yield curve. You hear about it in the papers all the time. You can find this in the Globe and Mail in the business section. It's extremely important to you. The reason is, if we looked at the global equity markets and the global fixed income markets, the fixed income market is twice the size of the global equity market. So we need to pay attention to it. It's important to your portfolios because you'll have fixed income components to your portfolios, but it's also important to making sure the economy runs properly. What we see here is, in terms of yield curve, is the top line is where we were in June 2007. And just to explain very briefly, the bottom scale is the maturity dates of different bonds that are government, in this case, Government of Canada. The left-hand axis is the yields, or what you get for that bond as a return on that bond. So what we're seeing here in 2007, short term, you're getting just over 4%, and 30 years, you're just getting over 30%. When you hear the term flat yield curve, this is it. There's no differentiation between a short-term return and a long-term return. What we're seeing right now is a steep yield curve. That means short-term, and this is the banks have driven down. This is what the central banks can control more closely, is the shorter-term rates. So they're low in order to try and stimulate the economy. Your economics textbooks will tell you this steep yield curve presents the opportunity for recovery, mainly because banks will take your money and pay you this and lend it out here. Now, they do a little bit more to protect themselves. They don't want to get caught with making sure their maturity dates don't align. But that's basically why a steep yield curve should be helpful to coming out of a recession. Now, the critical thing going forward for us all is what's going to happen next. We know short-term interest rates are going to go up. We don't know when, but we know they're going to go up. So the question becomes, as an investor and as a student of the markets, what you should be watching and looking for is this yield curve going to go up like this, right? Which means it's just changing its shape. So that means the short term goes up, but the longer term does not go up an equivalent amount, which means longer term fixed income investments are relatively safe. Or does the whole curve shift up, which means longer term fixed income investments are not as safe anymore because they'll decrease in their capital value. So I'm glad I'll be around afterwards. If you'd like to go through it, I warn you, I'd love to talk about this. It's the bond market.